Hey everyone, hope they're having a good day. My name's Andy. My channel is Finding Value. Today I'm going to go through Twitter like we normally do, see what people are sharing on social media. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, and see what's going on. If you want to follow me at _ Finance, and if you want to join our community, finding-value.com, where I share a lot more information about what I'm seeing in the markets with everyone in the community. We do have a special going on. Special is the coupon code if you'd like to join and get savings on either the monthly membership, which is a 50% off discount on just the first month only, or a larger discount on the yearly membership. And if you're on the monthly, you can always switch to the yearly if you'd like. So, Monday wisdom. Money problems often start with, sorry guys, I had to sneeze there. Often start with high interest debt, not investing consistently, not enough insurance protection, and no stability fund, emergency fund. Avoid these, and you're already on a better path than most. Another thing, people ask me, what should someone have for an emergency fund? And I'll just touch on these real quick. I have no high interest debt. I do not carry credit card debt or anything like that. That you got to get rid of that crap. You don't have interest rates work against you. That's not a smart move. Um, not in, I invest consistently. That's kind of what I do, but I guess I'm a different breed than most people. But an emergency fund, some people ask me, how much should I have in an emergency fund? What do I have as an emergency fund? And my emergency fund is really my precious metals to some degree, and that's what I store my money in. I mean, precious metals is money to me, so that's kind of where I store it. So, yes, I carry cash. Yes, I probably carry, 3, 4, 5 months worth of cash or something like that in bank accounts, but it's nothing over the top. It depends on how much your income is and your dividends and all that stuff versus what your expenses are. If you've got a big mismatch between your income and your expenses, you don't need, depending on how diversified your income is, you don't need to have a gigantic emergency fund. If your income and your expenses are close and you get paid from one location, like a job, you need to have a big emergency fund. Your emergency fund, if you don't have dividend income, if you're not earning from multiple locations, if you don't have, say, rentals or something like that, and it's only coming from a 9 to 5 with one location, and your income is very close to your expenses and you're not saving a lot of money, you need to have a gigantic emergency fund, in my opinion. You need to have like 12 months or at least 6 months, but probably closer to 12 months if that's the case, which means you need to save a lot more than regular. Most people need to save a lot more money than what they are. Um, if your expenses are like 10% of your income, which means you're rolling in the money, you've established a life where you're making dividend income as much as your 9 to 5, then it doesn't really matter because you've got streams coming in. And if a single or multiple streams were to go down or be eliminated, it doesn't hurt you with the same impact as a single source with a small buffer. So it really depends on your buffer. It really depends on your sources of income. And it depends if one or two of those sources were to go away, what would the impact be? And that's how I view life. I mean, it's how resilient you are. And the whole reason I am investing consistently is to make myself more resilient and to never go back to a 9 to 5 job ever again. Um, so that's kind of my whole that's what money gives me. That's the whole purpose of me saving money, is to do what I want and not take on jobs that I don't have to, and do stuff like that. HFI research says implied U.S. gasoline jet fuel distillate demand is almost 5% higher year over year. So 2024, you can see down here, this is 2024 in the dark. The orange is where we're currently at, which is basically the highest it's been over the past, say, 5 years or so. So demand is not the problem of why oil or any of these things are down. That's not the problem, at least not real-time data. It's not the problem. Maybe it will be in the future. Maybe these tariffs are going to have an impact. It's all a possibility. Trump, I don't know if this is true, but it says buy an American-made car and get 15K cash from the government. That is a bold move indeed. And I don't know how true this is. I didn't go back and fact check it, but all I'm going to say is where's that money coming from? Powell, if large increases in tariffs as announced are sustained, we will see higher inflation, lower employment. Yeah, I'm pretty sure that's what we'll see if the tariffs are sustained the way that they are. And that's the big question mark. That's the uncertainty that everyone is trying to figure out. So are these tariffs going to stay the way that they are? And I think Besant's been coming out talking about these, I don't know, agreements that may be coming soon. There might talk with China. The guys said a whole bunch of things historically. Who really knows? Who really knows what this guy's talking about? I mean, he's lied to us about 4 other times. I can't tell what's coming. So, what I'll say is no one knows if the tariffs are going to be where they're at. But if they do stay where they're at, definitely we are going to have problems with higher costs. I don't know about higher inflation, the way that inflation is the increase in the money supply. But yes, we could see higher costs in certain things. And yes, we could see lower employment as the economy needs to shift to these tariffs being in place to something that's different in the future. So the economy needs to shift itself to reconfigure itself, so to speak, to something that might be a little bit different configuration in the future. Silver Chartist says, breaking news, nothing notable came from today's FOMC meeting. I like it. I like it, Steve. And this is what came from the meeting. So the meeting says, summary of the Fed decision. Fed leaves rates unchanged for the third straight meeting. The Fed says inflation remains somewhat elevated. Uncertainty about outlook has increased further, no doubt. We all know that. Risks of higher unemployment and inflation have risen. I agree with both of those. Fed is attentive to risks to both sides of their mandate. Fed appears to see higher risk of stagflation ahead. The Fed pause continues despite Trump's calls for cuts. And these guys are going at it. Perhaps Trump is in the background pulling the strings, trying to get oil prices down and trying to get the inflation rate low so that Powell can lower interest rates. But it doesn't sound like Powell is caving in here. So the Besant Trump, we'll say, them teaming up against the Fed hasn't worked yet, is what I'll say, for lower rates and potentially a lower dollar, which if we get that, that will be inflationary, a lower dollar. Breaking, the Federal Reserve has not cut rates and keeps its benchmark lending rate steady at a range of 4.25 to 4.5%. Tavi's got we've seen this chart before. What he says here is almost exactly 1 year ago, Jay Powell said, I don't see the stag nor the inflation. Today, the Fed's projections anticipate both. This is a timely reminder that we're still grappling with rare trifecta of macro imbalances. Inflation like the 1970s, government debt levels resembling the 1940s, and equity valuations as stretched as in the late 1920s. None of us own enough hard assets in his view. And this is, again, the ratios. The dollar rolling over in the Plaza Accord, the tech bubble, and maybe tech bubble 2.0, which When they roll over like this, they generally lower interest rates in most of these cases. And then the dollar gets weaker against other currencies because that's the trade weighted index. We are at commodity bottom. So commodity boom time is coming, and we're coming from probably the lowest time in 100 years where this ratio has been so far out of balance. So when this dollar drops, that's when the commodity boom goes boom boom. And Jay Powell and Trump and Vicent are going to have a mess on their hands as inflation is a wrecking ball going through the economy. And that's also when emerging markets start to rip. So it's coming. It just takes time. We're just waiting for all this to play out. And Pow right now he's a party pooper. He's a party pooper because he's saying, well, I just don't see it in the data. So he's going to wait to see it in the data. We'll probably see it here. Who knows? Maybe we get some weakness. Unemployment goes up. And then it'll lower interest rates. This will all kick itself off. That's what I'm guessing is going to occur. HFI research, natural gas will be the first to spike in this upcoming multi-year energy bull market. I like it. I like that he's not even waiting for it. He's calling this a multi-year energy bull market. We're in a super cycle. We are close to the bottom of wave 2 in Elliott wave. It says that lower 48 gas production does not meaningfully surprise to the upside. The natural gas price spike happening later this year is all but inevitable. Here we go. And you know what needs to happen? We need to drill, baby, drill, but not at the prices that these guys want the prices to be. Natural gas isn't going to be cheap. It's going to be expensive. And then we're going to drill, baby, drill. And then I don't know if we're going to meet the demand in the time frame that we have. I mean, we need to really get drilling. Then maybe oil gets pulled up with it too. We'll see. My biggest mistake. So this is Peter Lynch, quote from Peter Lynch. He says, my biggest mistake was that I always sold stocks way too early. And guess what? That's also my mistake. So you know what I'm doing? Not doing that. I'm not selling my stocks too early. I'm going to ride them through the entire bull market of this commodity bull market. When this goes up and goes to more of like up here, not only will that be the best thing that's ever happened in my life, because I felt what it was like from here to here, and that was insane. It was an 8x of my entire portfolio from bottom to peak here. And yes, I have pulled back from that peak, no doubt about it. And I would love to ride it all the way up to this general area up here around the 100 mark. If that were to occur, and that's one of the things I'm using to potentially gauge a selling point out in the future, that would be life changing, massively life changing if we were to get up there, which I think it will. I think it will. Let's read a little bit here. It says, my biggest mistake was that I always sold stocks too early. In fact, I got a call from Warren Buffett in 1989. My daughter picks up the phone and says, it's Mr. Buffett on the line. And I pick up the phone and I hear, this is Warren Buffett from Omaha, Nebraska. He talks so fast. And I love your book, One Up on Wall Street. And I want to use a line from it in my year-end report. I have to have it. Can I please use it? I said, sure. What's the line? He says, selling your winners and holding your losers is like cutting the flowers and watering the weeds. That one line he picked up in my whole book has been my greatest mistake. Peter Lynch. That's Warren Buffett's greatest mistake. Mid Faber, he says, over the past 3 years, we've spoken to hundreds, if not thousands, of financial advisors. Can count on one hand the number that are overweight foreign stocks. Emerging markets is basically zero. Now that they are outperforming the 10, 30 percentage points year to date, will be interesting to see when the flows accelerate. And that's exactly where I am located. Foreign stocks and emerging markets. That's where I'm overweight if you were to look at the equities that I hold. I guess I am a true contrarian compared to financial advisors. But again, I don't chase price performance on a quarter-to-quarter basis. I chase maximum overall returns. With that dollar where it's located, when this turns, so it's like buying emerging markets here, here, and here. So looking at emerging markets, if you had purchased emerging markets, this doesn't go all the way back, but back here and it was way down here. We'll do EWZ just as an example. I know it's got the area. So if you had purchased down here, rode it all the way up and sold, maybe you're selling it when it was falling back down, sold in here, you got over, this was, let's say, an average around $10. We're right in here. And then if you sold it at 70 something bucks, you killed it. You did a 7x your money, 7 times your money from that bar to that bar. This from total bottom to top, this is a 20 bagger if you had purchased it bottom to top. 20 times your money in an ETF from 2002 to 2008, but you're not going to get the absolute bottom and you're not going to get the absolute top. And that's what the potential return is when that dollar starts to get crushed. So that's what I'm banking on. I'm banking on making hopefully somewhere between 10 and 20 times my money, or I'd be happy with even a 5 or 8x if I mistime things, which is fine, which is fine. EIA weekly data for crude oil. Since it's been falling, we should be seeing builds, right? Crude oil drawdown of 2 million barrels, gasoline flat, distillate down 1 million barrel, and Cushing down a little bit. This is a pretty big draw when you add it all up together between crude, gasoline, distillate, and Cushing. SPR is down 1.5. SPR was a 600,000 build, which will take forever to fill up the SPR doing 600,000 a week. So we are still drawing down on inventory for oil, which is using. The whole purpose of price is to balance your inventory levels. So if we continue to draw down on inventory levels, what's the deal here? What's going on here? It says, wow, implied U.S. crude oil production is 12.9 million barrels per day. April just finished 300,000 barrels per day below January. Well, there's your loss of barrels. Everyone's focused on OPEC bringing barrels back to the market. Maybe they are just displacing what the U.S. crude oil production is losing. Well, what if we lose more barrels in U.S. crude production than what Saudi Arabia puts into the market? That's still bullish, isn't it? What I would think. Here we are rolling over a little bit, and we're flat since 2022-23. Flat, 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 and we'll see if we decline. Over here, this is your crude production, and this is your monthly adjustment versus HFIR, U.S. crude oil production estimates. Sideways, sideways, sideways. And maybe we roll over if the prices get a little too low. Here's another one from Basent. The Trump administration, through our energy abundance, yeah, we were super abundant there. We saw that with the production up above and our depleting inventory levels. And signaling to the energy markets has brought crude oil down about 20% thus far this year. And he talks a lot about crude oil and gasoline, like he's bragging about it. But yet we've got this disconnect. We've got this disconnect between the inventory levels, demand, and the deficits we keep running, drawing down inventory. So are they doing something in the market to get this crude oil price down? I mean, obviously they put tariffs out there, which had a large impact on crude oil. It says, and I read with great interest this morning that Russian generation revenues were down 12% last month, which will put a dent in the Russian war machine. There's also ulterior motives of why they want oil down in the short term. These guys, Trump and Basent, not just the affordability for people filling up their cars, but it's revenue for some of their people that they may be going against or view as non-allies, is what we'll call it. Losing 10% is easy. Losing $100,000 isn't. Your risk tolerance changes when you start thinking in actual dollars instead of percentages. I don't know if I agree with that. What if $100,000 is losing 0.5% of your money? What if that's the case, or it's relatively a small amount of money for the person That's investing. Um, you don't lose money unless you sell. So if you buy an asset and the asset is volatile, it doesn't mean you've lost that money forever. I mean, obviously, if you sell, you're locking in that loss. Right now, if you look at Elon Musk's total net worth, he has a lot of money tied up in Tesla. He owns a lot of Tesla stock. He's down billions of dollars. Does that mean he should do something different than what he's already doing? Does that mean he should sell his Tesla stock because losing 10% or losing 1.5 billion or hell, I think he's down like 150 billion or 100. If he's down $100 billion, losing 100,000 isn't crap to him. But he's down 100 billion. Does that mean he's going to change anything? Is that your risk tolerance? Define risk tolerance. What is risk? What is your tolerance? If he's down 100 billion and owns all that stock in Tesla, and I hate to say this, but Jeffrey Bezos went through that. Mark Zuckerberg went through massive swings in his net worth. Elon Musk is currently doing that. I think that this is total garbage. What he's saying here, losing 10% is easy, but losing $100,000 isn't. Um, it's not about losing. You have to know what the game is. You have to know that there's volatility, and in order to make money, you got to ride through it. That's just the game. There is no easy way here, guys. No one has traded their way to billions of dollars. No one. So what makes you think that you're going to trade your way to $1 million or $100 million? No one's done it. They've all been guys who basically have founded their companies. They put a whole bunch of money. They get their bunch of stock in their company. A lot of them are pretty non-diversified. They're concentrated in the companies that they own, and then they just ride the damn thing for many, many years. That's it. That's what you've been looking for. And I'm not saying to concentrate into one or two companies. You don't know the company as well as Elon Musk knows Tesla because he's an insider. He knows everything that's going on with that company. He knows the financials. He knows what's good. He knows what he needs to work on, et cetera, et cetera. Here's another one. Why are they still trying to scam pump Bitcoin? It's hilarious. And, you know, I don't want to go to CBDC, guys. I really don't. But I think they're going to go there. Makes me sad that they're going to go there. Chris Vermillion flip flops 37.50 on gold. I will say this though, it's not about flip flopping. When you're a short term trader, they flip flop all the time. That's what the short term nature is. So you use evidence, you see where bottoms are, and then you flip flop, calling it from one direction or the other. That's just the nature of the short term. Medium term or long term, you look at different things. Longer term, gold is fantastic. Medium term, gold still looks decent. Shorter term, that's where people try to debate. Everyone makes their money on the long term. Everyone goes broke on the short term. And everyone flip flops and tries to figure out what the short term price is going to do. Most people are unsuccessful at predicting short term price movements. So, what should one focus on if you're going to be a successful investor? Focus on the long term, focus on value discrepancies in the market, and then buy those discrepancies and be able to hold on with patience. And most people can't do that. They can't be that patient, or they don't want to look at the value and be able to buy something when everybody else thinks it's bad. That is your advantage. And that is what the game that is what you must learn playing this game. And the reason it's easier to do this and be more successful at it is because no one else wants to do it. They all want to get rich quick. They all want to do technical charts on a short-term time frame, and they want to catch the 10 or 20% move, which is more or less closer to gambling than it is to investing. Another one from Basent. He says, we believe the United States should be the premier destination for digital assets. Oh, crap. There's that CBDC coming. Digital assets are an important source of innovation that can drive usage of the US dollar around the world with stablecoin legislation. Oh, crap. Here it comes. I don't want to see this, guys. I really don't. I don't want to be tracked. I don't want time things. God, I really don't want this. Anyway, U.S. trade deficit widened to a new record in March. There's your trade deficit, and that's what they're trying to stop. So we'll see if this goes in the other direction or not. But right now, trade deficit looks pretty ugly. Eric Nuttall, valid demand worries and uncertain OPEC plus policy trump low inventories for now. Yet, unarguably, this is not bearish. Look at the deficits here. Ever since 2021, we're on deficit heaven here. Does that look bearish? Look at the deficits coming over on the right-hand side here. Look at those things drop. You know what this screams? It screams that the price of oil is too low. And that's why we're getting these big deficits. A lower price spurs demand. And why are we down here with these big deficits that are increasing? It won't last forever. It won't. This is the US Big Three crude gasoline distillate inventory level, and there we are right there, rolling over, coming on down for 2025. And there was a year that was lower than this. 2022 was a little bit lower, but we also had massive prices in 2022. They were way higher than they were over double where we are today. Double. Is war bullish for commodities? Asking for a friend. Yes, that is. I think things will soon get out of control. Unfortunately, this tweet might age well. What does he mean by things will get out of control? Is it the price of gold? Is it shortages? Is it all of the above? Maybe. Manish says, you're likely to make the most money with the ideas that are the simplest. Manish Pabre. We have freight futures. Freight futures were split on dry bulk, Panamax up to, Capesize down to. Tankers down to for VLCC and flat for Suezmax. This is Grady. He says, fortunes will be made. Fortunes. Seeing many arguing that precious metal miners are no good just because they, for periods, are lagging the metals. That is not very useful information, and repeating that endlessly shows one does not understand the miners or big picture charting. Just like the metals, playing miners is all about timing. Many are also worried about the miners that the miners are not outperforming metals big yet. But it is not unusual for metals to take the lead up from big lows. And when the wall of worry really gets going, we will see 8 to 10% up days for GDX and 10 to 15% up days for SILJ. And I don't even want to say what the up days are going to be like in some of our speculative stuff. The miners bull will evolve in stages. The third stage for miners, up from 2022 lows, started 4 months ago. When the ratio below moves up, fortunes will be made. GDX versus GLD, it's bottoming, ready to move on higher. And this is a 12-year long base. The bigger the base, the higher in space is coming. Now, that doesn't mean that I put all my money into the miners. It means that I allocate a certain percentage to it and let it go. And then be patient and wait. That's all you got to do. Patience. API crude singing a little bit different story. We were down 4.5 million barrels, down about 1 million in Cushing, 2 million in gasoline, and we're up about 2 million in distillate. So that's a big draw as well using API. During a lifetime, you will own 10 to 20 big winners and hundreds of losers. Successful stock picking isn't just picking winners. It also means picking out the losers in the portfolio. Losers aren't stocks that are down. They are the underperforming businesses that you keep holding. Those are the losers. Another one from HFI Research. He says, we are seeing signs of associated gas production weakness. It's still early, but I do think the weakness in U.S. shale crude oil production will impact associated gas production. Here's the problem. We need to go way up in gas production by the end of year of 2026. And we're going down in nat gas production, or we've got some weakness here in the short term. Guys, we got to get on this. I mean, nat gas could get this could get pretty crazy here, is what I'll say. The Fed is the only buyer of U.S. Treasuries. Few understand this. Yeah, it makes sense. Gold and silver ratio back to the Civil War, approaching a historic peak. When silver breaks $35 an ounce, it will begin to outperform gold significantly. This is going all the way back, and you can see the peaks of gold outperforming silver, and we've got maybe three peaks here. Now, some people say, well, what if it breaks to the upside? I don't know. It's a possibility, but that's not how I would bet. I would bet that silver is going to outperform gold at some point in the future here. That's probably what I would bet going forward over the next decade. And that's where we're going to end it. That's all I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We've got that special coupon code still going and a Q&A session on Saturday at 7 a.m. Mountain Time. Okay, guys. We'll catch you later. This is Finding Value.